Hey guys, Brian Stevens, National Real Estate Post. I have Dave Stevens, again, of no relation that we know of, who ran the MBA, ran the FHA, and now is a private consultant and works with a multitude of different lenders all across the country right now. Who, by the way, I would recommend if you have a LinkedIn account, go look up David H. Stevens on LinkedIn. There's always great stuff that's posted over there. I think it would help you understand this market a little bit better. Dave, how are we doing today?
I'm good, Brian. Good to be with you again.
The reason I wanted to talk to you today is it's kind of like last week, is looking for some type of clarity in a market that doesn't seem to have very much. Right now, if you look at some of the policies of the Fed, what they're doing by raising rates, it seems to me they're kind of going down that Volcker road from years past. Then we're also hearing from a number of other great prognosticators that the Fed's moves right now are just going to exacerbate an already bad situation. Is there any type of agreement in Washington or from our policymakers that this is the right thing to do right now to continue to raise rates? Or is killing the economy to get inflation under control a good idea?
When the cost of goods is rising faster than incomes are increasing, that's an unsustainable premise. And so the Fed really has no choice but to slow the economy down. Now, you can put a whole lot of blame on what happened as a result of overreacting to COVID. Through three major pieces of legislation that put money everywhere, and then the Fed's subsequent quantitative easing that they put into place, which was massive and created this, huge short that drove rates down to the twos. All of that created so much excessive stimulus to the economy that now we're paying the price for it, right? We still today are sitting here as we're recording this with too few people chasing too many jobs. We still have home price appreciation that's really huge year over year. We're still almost at 10% year over year on a national basis. And granted, we all can feel it. We all know it's going to slow. We are all worried about maybe home prices even flattening or declining some. But I can assure you the Fed is not going to slow what they're doing. This quantitative tightening is what, as we call it, is going to continue. They've absolutely, not only have they stopped buying mortgage-backed securities, they're not even buying the amortizations, and which is what they used to do. They would buy the payoffs and just standard amortization and then replenish. So we've just taken the biggest buyer of mortgage-backed securities out of the market, and there is no replacement. In fact, a lot of other institutional buyers are backing away. And one thing that makes this a bit more complicated, there's a variety of things that make it more complicated in terms of uncertainty, the ability to predict what's going to happen with rates, such as looking at the average spread over the 10-year, which is so wide right now. It's 4 standard deviations outside of normal in terms of the 210 spread or the 30-10 spread. But as we think about all of the domestic challenges with inflation that was created, then we have the Bank of England that is almost taking down the entire country. We've got a complete crash of the yen. Japan is literally plummeting. It's a major potential global threat. And as a result, the United Kingdom, for example, is selling bonds, selling U.S. holdings in order to shore up the Bank of England. And that's just adding more supply to the market. So these are technical factors that are just part of what we're dealing with right now. It won't be this way forever, but I am certain, and I speak to a lot of people who are deep into the financial variables that are moving this domestic economy right now and the global economy. I was on a long call with some of those earlier, and there's just a general consensus. This next 12 weeks, this winter, this fourth quarter, really November, December, and January are going to be 3 really hard months. It's going to get worse, I think, before it gets better in terms of sort of interest rate predictability. And I could talk a lot more about it, Brian, because let me just give you one small other piece of it. Today, the current coupon for Fannie 30s is 6, right? I mean, literally a month ago, it was like 4.5 was current coupon. I mean, it's just crazy what's happened here in the markets, or maybe 2 months ago. But the other side of it, I would say, is one of the things that's driving this is, in fact, I'll show you, we're looking at, a totally inverted market. So if you look at spreads down on the bottom section, if you look at the yield curve between the 210 and the 25, it's negative, right? So this is the spread difference, and now we're negative. We have a negative spread on the spread between 210s and 25s, which tells you that the long bet is for rates to come back down. And so if you ask yourself, why are my 30-year fixed rates at 7% today? One, no one will buy that. Very few buyers. Forget the Fed. Institutional buyers don't want them. Why? Because you cannot predict duration. There's no DV01 for those in capital markets. There's no way to model duration on a 7% mortgage especially when you see this inverted curve and the bet is that rates are going to come back down, because that means the duration is going to be extraordinarily short. So the only investors coming in are those that are willing to take the bet on the unpredictability of the duration model, but they're only going to do it for an extraordinarily high yield. And that's what's creating that massive difference between how the 30-year and the 10-year is priced today, like 225 basis point spread or whatever, not the 125 that it normally is. And so I believe that's going to remain for a bit while all of this emotion is in the market. And it only got worse with, a potential threat of a nuclear war, even a regional one between Russia and the UK and in Ukraine, and then what's happening in Japan and China, frankly, has slowed buying. So it's incredible. I'm going to end with this one thing. What people ask me all the time, they go, well, the supply is a lot lower, right? This market right now is $2 trillion smaller than last year. So even with the Fed not buying $70 billion a month, we're $2 trillion smaller market. Isn't the supply smaller? Well, the problem is, yes, the supply has shrunk dramatically. That's helping. But the other institutional buyers that were in the market are not buying either. And folks like the Bank of England and actually the United Kingdom Central Bank, which is really Bank of England, are dumping mortgage-backed securities. And so we're still short right now as in tradable currency today. We're short about $1 billion worth of normal buying power, even in this shrunken market. And that's because we lost all these institutional buyers because no one wants to bet on the duration of a 30-year at 7%. And so this will all self-correct. I assure you. I mean, you'll ask any economist, anybody's look at this, will rates come back down? Oh God, yeah, they're going to come back down. Barry Habib would say, much sooner than a lot of other folks are saying, but it's just a matter of how long we get through it. And so the end point here is, no, the Fed's not going to back down. Inflation is still crazily out of control, and they've got to get that under control. And so far, they have not by any means whatsoever. No reports showing it. We saw the CPI report last week. It's going to take us at least through the rest of the year to see any economic conditions that would make the Fed slow down. And that means another 75 basis point hike in November is almost a certainty. And so these are the things we got to be looking at as we think forward. It's going to be a really tough winter, but beyond it is going to be still the fundamentals of a strong economy that's more normalized. And even if we bump into recession, I know some folks hate this expression, but it should be a soft landing type of recession, at least the way things look today. And so, I know people are freaked out. They wish they had some way to predict what's going to happen here. All I would say is that 7% rate you're giving to your home buyer today is artificially high. It's high because of the emotion in the market and the real reality that even regular institutional buyers of agency mortgage-backed securities just aren't going to take a bet on being able to model what a 7% is going to do. So they're just staying out, completely out. And that only exacerbates the problem, right? It just makes the spread go wider, not tighter. And so until we see what the Fed's doing, until there's clear notification that the economy is slowing, that'll force rates to cool. The inverted curve, you can just go on whatever, rate quoter you get today and just look at the price of a 10-year treasury against the 30-year treasury, and that's inverted. So there's also, you have to look at the 210 or the 25. That just is a clear indicator that everybody knows. I mean, it's not a guess. Everybody knows that as the economy slows and the Fed's actions actually begin to work, that long yields are going to drop, and that's going to reflect how the market's pricing them right now. And that'll bring the spread between 30 years and 10 years at some point back to the more traditional 125 to 150 range. And we'll get back to that predictability, Brian, that you always, are asking about.
So when you look at our supply line disruptions that we continue to have, I read somewhere they said, well, even though we've got low unemployment figures right now, 50% of the workforce that we had prior to COVID simply has not come back to work and is not going to come back to work. So we have fewer people who are actually working. It seems to me like some of those people who we had working previously would help facilitate some of our supply line issues. That doesn't look like it's going to be fixed anytime soon. How much is that playing into inflation. And that's something that the Fed really can't take into consideration. I mean, the Fed can't do anything about that.
I know we keep talking about people are still not working. No one's getting free paychecks anymore. So I actually believe people are working. I just think we are short employable Americans to fill these jobs. I just think that's reality. And most of them are service jobs, right? I mean, if you read the points guy, the guy who follows airlines, there's all these expected slowdowns that are going to be occurring at in the airline industry and at airports through the winter. And he actually gets a checklist of that you should bring extra clothes, you should bring toothbrush and toothpaste because you may have long stays at airports. That the lounges, if your members may not have enough staff to serve drinks and all the stuff that they're suggesting, meaning that the biggest shortage is in the service industry, unfortunately, and we just don't have enough employable people. It has a lot to do with immigration challenges and a whole bunch of other stuff. But again, when you have a wicked hot economy, Americans are still spending a boatload of money, and we're not behaving as though we're in recession, right? I know the mortgage industry feels like we're in recession. We feel like we can feel it, and we can. We're on the blunt edge of the sword here. But in the end of the day, the economy itself is still roaring hot. People are spending tons of money. Maybe we'll see it in retail sales expenditures when we look at post-holiday sales. But at least for right now, we're just short workers. And I don't think it has to do with a whole bunch of people who didn't want to go back to work. I think generally speaking, we're a fully employed society. We only have 3.4% unemployment right now. So it doesn't leave you a lot of people who are sitting on their thumbs deciding not to work at this point. We do have too many retirees, unfortunately. Too much of the population has stopped working, although they may go back to work if the stock market keeps doing what it's doing.
Now, the Feds they keep coming in doing 75 bips here, time and time again with their raising their benchmark. And I know that the inflation was better, but it's still higher than where the Fed wanted it or where they thought it was going to be at this time. If we know that we're going to get a 75 or basis point hit this November, and we're probably going to get one next November, wouldn't it just be smarter to do like 1.5 right now and try to get ahead of it instead of, going at this at a snail's pace?
Yeah, there are people a hell of a lot smarter than me that make these decisions. But I do think that one thing the Fed knows, and they actually learned from March of 2020, is when you overreact, you can create all sorts of problems as well. I mean, let's remember 2020, what they did to the 30-year MBS market and all our pipeline hedges, et cetera. I mean, it was dramatic and posed extraordinary risk. And so, you don't want to repeat of that going the other way either. So I think what they're doing is, as you know, they originally started a 50 basis points increase. They moved to 75s,
right?
And they're still doing this incrementally because you want to see then each subsequent spending report to see if we see slowdowns and unemployment reports as well, to see if we're seeing any shifts in the economy. And they depend on that data. So in many ways, I know a lot of you guys would say, just let's pull the pin, man. Let's get this done and level set. When you don't know really where the floor is, you don't want to shoot through it. And so that's what we have to be careful about doing.
Now, on a totally different topic now, real quickly, there seems to be, in years past, appraisers and appraisals pretty much went by unnoticed for my entire career. And I'm assuming for years and decades even before that. All of a sudden, it seems like every appraiser has just forgotten how to do an appraisal and all the values are screwed up. And I'm seeing from the CFPB coming out saying you should fight these things. Low appraisals are bad, high appraisals are bad. Challenge these things. This seems to be a talking point from different agencies over and over again. And of course, the other one is the discrimination nature of appraisers right now, something we never heard about before. All of a sudden, these become talking points, and it happens to coincide with our dwindling supply of appraisers. We simply just don't have the number of appraisers coming into the business that we need in order to continue the status quo. And at a time when Fannie and Freddie look like they're going to run out a much more full-time automated appraisal service, it seems a little convenient right now to throw these appraisers under the bus as a means of rolling this out and looking like the good guy. Is there any of that taking place, or did appraisers really forget how to do appraisals, and did they overnight start this wildly discriminatory nature in their appraisals?
I would suggest, one of my clients is trying to call him, I would suggest that you look at it from this perspective. First of all, home valuation modeling has been around for decades. I ran the single family business at Freddie Mac in the early 2000s, and we had Home Value Estimator was our AVM, and property inspection waivers were happening even before the Great Recession. Obviously, they were happening in a big way during the refi boom of 2020 and 2021. And that was simply because you could run a quick AVM through DU or LP. They would run it, and then they'd issue back a PIW. But what compounds the concern, I think, for policymakers is there is real risk of, well, there's two things. One is greater efficiencies come from eliminating as many touch points as possible. And the mortgage process today is still, has yet to be truly Ubered or Amazoned or whatever you want to call it. We still operate in many ways very similar to the way we used to. FHFA has a fintech group that they had a big meeting on, and asked a whole bunch of people to give opinions on the future of fintech. And look, one of the big subjects is we haven't even got fully automated payroll yet, which is ludicrous to me that you can't automate income validation information pre-approval. I mean, we do it after the fact through a 4506 or whatever. We can't do it pre-approval. So a whole lot of areas need to be automated. And appraisal is one of those that if you could do it, think of the efficiencies you get. You reduce time, you can get instant valuation if you can trust it. Problem with home valuation modeling up until today was it was very difficult to get accurate appraisals on anything that was rural, newer properties that didn't have resale comps, other kinds of properties that weren't traditional single family. It was much easier to get AVM hit if you were doing a single family resale of a home in a cookie cutter neighborhood. Those things that have high probability of matching. But things are really progressing. There are models like ProxyPix. If you look up ProxyPix or download the app, they're taking almost the Uber model with incredible technology improvements, and they're doing an automated valuation without the need necessarily for a human body to walk into a home. You can just literally have, through geocoding and all sorts of security protections that make sure that they're fresh photos being taken by someone who drives by the house, you can get a really good and a much more sophisticated AVM. You can get a full appraisal done on a home in an hour or two. Now, is it a universal answer to an industry that is slow because its methodology it requires that's aging? That's very difficult industry to get in. It requires an incredible amount of hours, almost more than because it does to become a CPA, to become an appraiser. And we don't have a lot of people coming into that part of the industry right now. And so the rush to come up with an automated solution is only more exaggerated. And then, this question of discrimination, I don't care who wants to hear it. I know specific examples. I have an African-American friend who's a senior executive and, got one appraised value on his refi on a beautiful home in Northwest DC, and then whitewashed it, had a white family sit in when the appraiser met the home, changed all the photos, and the value came back $140,000 higher 3 weeks later. And those stories are real and they're out there. Now, is every appraiser discriminatory? Of course not. But does discrimination exist in every industry in America? Yes, it does. And so, that's another thing that if you can take out the human bias part of property valuation, you just eliminate one more inherent credit risk associated with underwriting and approving a lien, a mortgage on a home. And so, are appraisers getting values wrong in mass? 99.9% of the time? No, they're getting it right. But we do have an aging population. It's really hard for them to keep up with volume. And as you guys all know, today we're all concerned about going fully automated. A couple of years ago, when there's massive volume, everyone's complaining about appraisers being sent in from other areas that didn't know the local community. And there's always a complaint to be had about anybody who has to do a job like this. But I think, frankly, that automation, not just in this field, but across the mortgage sector, is what's going to ultimately transform the mortgage industry and affect everybody's job in the space at some point.
So last question, you bring me to my final point. And this is something that me and Frank have discussed over the past 20 years. We're pulling our credit reports, which is automated, verifications of employment, deposit, automated appraisals. The entire process becomes automated. How many more years does a loan officer have before they are automated out of a job? Honest question.
Well, look, I will tell you, and I talk to a lot of mortgage CEOs, and it's a love-hate relationship with a CEO and their loan officers, because in the end of the day, your single biggest expense is that individual. And now you're seeing, 7-figure paychecks being written to recruit people into their companies based on previous production, et cetera. Does that job ever get eliminated? I used to give speeches on this over the last couple of years about, you need to make sure you're finding a way to add value that makes you a mandatory part of the process, regardless of how automated the process goes. And, today you can get a car loan online, but they still have the finance guy at the auto center. I think the trend, I hate to say it, and the trend, if you look decades out, is likely negative on the kinds of commission spreads that we're seeing in today's market. And I think that's just a system that will change. But today, fortunately, real estate agents still aren't comfortable just turning the borrower over to a call center. They like to know that their borrower's dealing with John, who they trust, or Jane, who they've worked with for years, and they know gets the job done. And so that human value is still high. I just wonder, as realtors age out and younger realtors come in who are more trusting in technology, I just don't see any way you change the trend of what I just said a moment ago. Ultimately, we're going to have people who live on the internet, they grew up on the internet, and they trust sources that are internet-based to help them with the process. And once that occurs, if the efficiencies are really good, I think all bets are off around how many traditional LOs we will have in a future world that operate like they do today.
Yeah, I mean, what's to stop a real estate agent from saying, "Hey, I got a landing page. You fill this information out. It all just pumps into an automated system and it kicks out an approval." I don't think it would take too many approvals that happen almost instantaneously to have a real estate agent change their loyalty from one of their friends to one of these automated.
But one thing I would say, because I'm going to get a lot of blowback.
Oh, I am too.
Here, and all I would just say is, I do believe it's years down the road. I mean, I don't think it's anything like in a short-term worry, but I do think as we think business strategy and adding value. And by the way, a lot of us loan officers, I was a loan officer, but a lot of loan officers are in their 50s and 60s, and they'll be gone from the business by the time we see a fully automated society. However, that pace could change. I mean, you all remember when Uber first came out, everybody laughed at them. Same with Amazon. Everybody laughed at Amazon. They'll never kill retail. They did kill retail. Uber killed the taxi industry. And so, no one thought that would really happen, but it made our lives better in many ways. But it did completely transform the transportation and retail industries in a way that nobody could have ever seen, except for Jeff Bezos, and I forgot who founded Uber. But that's the deal. I also wouldn't be so quick to say, it's never going to happen. You guys are full of crap. I would just say, guys, I think the probability is almost absolute that that's where we will be at some point. I think the timeline as to when that happens is years down the road, but it doesn't mean you shouldn't be thinking about it. Shouldn't be thinking about what are ways that I can, as an individual, that my team can be a value-added provider that makes me a necessary component of the transaction, regardless of technology. And that's really the question that I think is going to differentiate the winners versus the losers there.
Yeah, and to support what you said just a moment ago, this is going to get people mad at me, but when and I've had this conversation with a number of CEOs of mortgage companies, and trust me, they all think this. If they say it or not, they all think this. They'd all like to get rid of all of you. They just would, because you're the most expensive part of the transaction, and they all think you make too much money, and they all think you're prima donnas. That's the truth, if they say it or not. No names needed. This is pretty much across the board. But I do want LOs to consider this. Like, if you have a comp, you're in like a 150 bucket, 125, 175. I know some of you are in like 200, even 225 buckets. Well, property values have all but doubled over the past few years. So you're now making twice as much as you were just a couple short years ago. But your compensation of making 1.5 was based on a time when you had to handwrite your good faith estimates. You had to handwrite your 1003s. You had to mail out for all of your verifications. Everything was a paper process. Everything was slower. Everything was much more involved. Doing a loan took twice, 3 times the time that it takes to write right now. So there's been tons of efficiencies that have been made in the mortgage space to make all this stuff easier on you, and yet your compensation hasn't moved. So it stands to reason, and I'll tell you this, and don't blame me, don't blame Dave, but there are going to be long-term mortgage solutions coming out, paying a significantly lower compensation with maybe a little bit more competitive of an interest rate. And that's what's going to change your compensation. It's not going to be a decision by a CEO of a company or anybody who's running our agencies. It's what the market is going to dictate. And you're already starting to hear murmurings of this stuff going on right now. And as we find more automation and things become easier, it stands to reason that we're going to need to reconsider our comp. My thinking is we'll have fewer loan officers and you'll behave more in the capacity of an outside account rep than you would a traditional loan officer where you're filling anything out. You'll have systems that are going to pick the program, pick the pricing, automate everything gets loaded in. And, maybe closing more transactions with less involvement at a lower works out better.
The other variable, this is a subject that just pisses off so many loan officers.
Oh, I know.
But it's a good one. And look, I was a LO, and once an LO, you always think like an LO. So I get
totally
it.
True.
But go back to your story. When I first started as a loan rep, yes, I had to stand in line at the bank to get a VOD filled out. I hand drove my file to a MGIC underwriter, and at 5 o'clock, pleading with her to do that file before she left for the day. But the other thing is, we had product variability. We had more variety of adjustable rate mortgages back in the day. We had graduated payment loans, different indexes, all sorts of different products. Not only is it automated, we're in a QM world, guys. Where, honestly, the most complex decision that you help the borrower through is, do they do a 2-1 buy down? And if it's a jumbo, do they do a 7 or 10? I mean, there ain't much more to that. The product variability has shifted. It just doesn't exist in any way, shape, or form as it did back then. So even counseling someone on a product is far less difficult than it was back in the day. And to your point, yet the commission, the basis points and commission has not changed, and the loan amounts are, multiples of what they were back in those years. That's great. I mean, that means that you guys, as long as you can stay in this business and we get to the spring market next year, every deal you get, you're going to be paid more than any of your predecessors just because the loan sizes are so much bigger. But it to the long term, I think it's sort of fait accompli that you should expect that there'll be some form of transformation in how this whole process works, and we'll all be part of that, including loan officers.
David, Mr. Stevens, thank you so much. I appreciate your time.
Great being with you, Brian.
All right, I'll talk to you soon, I hope.
Okay, take care.
You too.